Hey everyone, and welcome to The Explainer. Today we're diving into a really interesting company in the ad tech world that's been on, well, a total roller coaster. We're talking about Digital Turbine, or as you might know it on the market, APPS. And that brings us to the big question on everyone's mind. After a really rough patch, the numbers are starting to hint that something's changing. So could we be looking at the start of a major comeback for Digital Turbine? Let's get into it. You could say Digital Turbine is at a genuine crossroads. The source material we're looking at calls this a potential inflection point, and that's the perfect way to describe it. After a very tough time, we're finally seeing some real signs that things might be turning around. So where does this turnaround story really start? Well, like with most things in business, the first clues are in the numbers. Let's break down their latest quarterly results, because they've definitely got people talking. First up, this number, $119 million. That's the revenue they pulled in last quarter. Now, by itself, that's a solid number, but what's really important is what it represents. It's a signal that the ship might finally be changing course after a long time. And here's exactly why that revenue number is such a big deal. It marks a 6% increase compared to the same time last year. Look, after a pretty painful period of negative numbers, the company is officially growing again. 6% might not sound earth-shattering, but trust me, when you've been going in reverse, any kind of forward motion is a huge win. But just growing the top line? That's only half the story. The real test is whether that growth is actually profitable. And that's where this 48% comes in. It's their non-GAAP gross margin. In simple terms, it's a measure of how good they're getting at making money. It shows that all their cost cutting is paying off. They're not just growing anymore, they're growing smarter. Okay, so one good quarter is promising, for sure. But that doesn't make a trend. So what's the actual plan to keep this thing going? Let's take a look at the company's strategy and what they're telling investors to expect down the road. What I like here is that their plan is pretty clear and easy to understand. It's a two-pronged attack. First, they're going to double down on brand advertising, which is a really strong market right now. And second, they're going to use their own unique first-party data to give advertisers something special, a more direct, efficient way to reach customers. So what's the payoff for that strategy? Well, here's what the company itself is forecasting for fiscal year 2026. They're predicting continued revenue growth, which is great, but more importantly, they expect their Adjusted EBITDA, which is really a key snapshot of their core profitability, to hit somewhere between $85 and $95 million. Let's put that EBITDA number into context. If you translate that guidance into a percentage, you get a really healthy 17% margin. This tells you they're confident they can not just grow, but do it profitably. And that is exactly what you want to see in a turnaround story. So you add up the revenue growth and the improving margins, and what do you get? You get this number, an estimated $100 million. That's the goal for annual free cash flow. Think of it as the pile of cash left over after paying all the bills. That's money they can use to pay down debt or reinvest in the business. In any turnaround, cash is absolutely king, and this is the end goal right here. Okay, so we've heard the company's side of the story, we've seen their plan, but how does our source analysis translate all this into an actual investment outlook? Let's check out the forecast for the stock itself. And here is a direct quote from the analysis our explainer is based on. The technicals suggest that the stock, APPS, could be testing that $11 level in the next few weeks or months. This really shows a belief that the momentum we've been talking about could start showing up in the stock price. And just to put that $11 target into perspective, depending on where the stock is trading, that implies a potential upside of over 50%. I mean, that's a bold call, and it really highlights the optimism that's building around this potential turnaround. Now, this is really important. This is not financial advice from us. We are simply reporting on the specific strategy that was laid out in the source material. It suggests a possible approach of starting small now, and then maybe considering adding more if the stock happens to pull back into that $4 to $5 range. Of course, no investment story is ever just one-sided. The potential rewards here seem pretty clear, but it is just as crucial to understand the hurdles that Digital Turbine still needs to clear to make this turnaround actually happen. And this really gets to the heart of it. On one hand, the rewards. You've got growth coming back, margins getting better, and that huge potential for free cash flow. But on the other hand, you have the risks, and the source is very clear about these. The company is still carrying a lot of debt, and despite the improvements, it's still posting net losses. So that's where we are. The numbers are pointing to a change. The strategy seems solid, and the potential upside is pretty significant. But those risks, the debt, the losses, they are just as real. Which leaves us with the one big question to ponder. Has Digital Turbine's turnaround story truly just begun? Thanks for joining us.